Many people are under the misconception that you need a lot of money to start investing, but the truth is $100 can be a great start for anyone looking to build wealth over time. There are several ways to turn that small sum of money into a substantial nest egg. Here are 6 of them. 1. Use a robo-advisor. Many people think that investing is only for the wealthy, but thanks to robo-advisors and investing apps, it's now easier than ever to start an investment fund with just $100. Robo-advisors are digital investment services that automate the process of managing an investment portfolio. They offer low to no cost investment management by using algorithms to help manage your assets based on your goals, risk tolerance, and investment horizon. To start with a robo-advisor, you will need to register on their website or app and complete an intake questionnaire that helps them understand your financial goals and risk tolerance. Once you've funded your account, the robo-advisor will then use algorithms to build a diversified portfolio of investments, typically ETFs and mutual funds, that are optimized for factors like cost and tax efficiency. Then, once you decide how much money to invest on a regular basis, the robo-advisor will automatically transfer that amount from your bank account into your investment account on a predetermined schedule determined. Some robo-advisors require a minimum initial investment amount, while others have no minimum. The cost of a robo-advisor will also vary based on the features you're looking for, so be sure to shop around and compare fees before choosing one. Another option is to invest directly in the stock market with a broker or through your workplace retirement plan. However, this requires a certain level of financial literacy and a lot of time to research stocks and build a diversified portfolio. Plus, the stock market can be volatile, so you're likely to lose some of your investment. Also, if your employer offers a Roth 401k, you'll be able to get the advantage of tax-free growth on your contributions. To put it in a high-yield savings account. A high-yield savings account earns a higher interest rate on your money compared to standard savings accounts, but there are a lot of things to consider before you choose the right one for your needs. For example, some high-yield savings accounts charge fees, have minimum balance requirements, and may not offer other banking services like mortgages or credit cards. Compare the pros and cons of different options to find the best one for you. The next step is to decide how you want to invest your $100. The type of investment you choose will depend on why you're investing, says Jen Hemphill, an accredited financial counselor in Wichita, Kansas. What you're saving for, college education, a home, a medical procedure, or retirement will determine how much risk you're willing to take, she explains. If you have a short investment timeline, you might be better off parking your money in an emergency or rainy day fund. But if you're planning for longer-term goals, such as a career change or a vacation, it could make more sense to take on some risk and invest your money. Before you start investing, however, it's a good idea to pay off any debt you have and build up 3 to 6 months worth of emergency funds. After all, if you're losing money on interest charges in your credit card or student loan repayments, that's more than you'll be making in investment returns. 53. Invest in stock index funds. While having a savings account and emergency fund is important, investing for the long term is just as crucial. It may feel like investing isn't worth it if you only have $100 to spare, but there are plenty of ways you can invest that money and see it grow over time. The easiest way to start is by investing in stock index funds, or ETF. They are low cost and can help you diversify your portfolio. You can buy shares of these funds in a brokerage account, individual retirement account IRA, or Roth IRA. The number of shares you can buy will depend on the share price and your investment budget. With a little patience, you can watch your investment grow over time. Ideally, You should check in regularly but not obsessively to make sure your investments are on track with their goals. And don't forget to reinvest your returns. A good rule of thumb is to only spend as much money as you can comfortably afford to lose. So if you have invested your $100 and it takes a hit during a market downturn, don't panic. You'll still have enough to purchase more shares at a bargain price. It's hard to imagine someone making $1 million on an NFT or cryptocurrency, but there are real-life examples of people turning small sums of money into huge fortunes. Of course, these stories are exceptions, but it is possible to become rich by investing what you have, even if that amount is only $100. The key is to start early and stick with it. With some diligence, you can use your $100 to turn it into $100,000 or more. Chapter 4. Invest in bonds. Investing can seem intimidating, but you can use $100 to start small and work your way up. You may have to make sacrifices in the short term, but if you keep up with your savings and investments over time, you can turn that money into thousands or even millions in the long run. One of the best ways to invest $100 is by signing up for a brokerage account, which can be used to buy investments like mutual funds and stocks. The broker will help you determine what kinds of investments to make, and you can also choose how much risk you're comfortable taking. If you're not ready to take on as much risk, you can also invest in bonds. Bonds are loans to governments or companies, and they promise to pay you back the original investment by a certain date, known as maturity. While bonds generally don't generate as much income as stocks, they provide diversification and stability in your portfolio. You can also invest in individual stocks if you have a bit more money, but this is typically more complicated and requires more research. Another option is to use an index fund or ETF, which can give you a diversified portfolio for a low price. These can be especially helpful if you're new to investing. Finally, you can invest in peer-to-peer lending, which allows you to lend your money directly to individuals or businesses through online platforms. These platforms typically undergo standard verification processes, and you can browse available loans to find ones that match your goals and risk tolerance. Depending on the platform, you may be able to earn interest payments as well. Chapter 5. Invest in real estate. The investment process can seem intimidating for those who only have modest sums to invest. But it's important to remember that compound interest can snowball, even seemingly insignificant amounts of money, into sizable nest eggs over time. Stash your spare change in a savings account to earn modest interest, or put it in one of the best robo-advisors to help you make the most of your $100. Alternatively, you can choose to invest your money through stocks, bond funds, real estate investment trusts, or micro-investing apps that let you purchase fractional shares of companies with higher revenue potential. Real estate investing is a popular alternative to stocks and bonds, offering the possibility of income from rents as well as appreciation when you sell your properties at a profit. It's also a good way to diversify your portfolio, as it's subject to different economic influences than stocks and bonds. However, it requires a lot of time and capital to become successful. Many people also find it difficult to manage their properties on their own and may opt to hire property managers instead. Investing your $100 is a great way to generate passive income, prepare for financial uncertainties, and achieve your long-term goals. Whether you're stashing it in a savings account, using a robo-advisor, or buying shares of the right company, a little bit of discipline and savvy can go a long way toward helping your small investments grow. But it's important not to wait until you have thousands of dollars to invest. The sooner you start, the better off you'll be. And if you're not ready to commit to investing, there are other ways to save for the future, like by paying down debt or saving for an emergency fund.